Fundamental analysis is the cornerstone of making informed trading decisions, and understanding it can transform the way you approach the markets. At its core, fundamental analysis means looking beneath the surface of price charts to discover the real forces that drive the ups and downs of financial assets. Whether you're trading stocks, commodities, or currencies, mastering this approach will help you anticipate movements, manage risks, and seize opportunities with greater confidence. Let's begin with the building blocks of fundamental analysis. Economic indicators. Think of these as the vital signs of an economy, providing crucial insights into its current state and future direction. Among the most important indicators are gross domestic product, or GDP, inflation rates, interest rates, and unemployment figures. GDP is the broadest measure of a country's economic activity. When GDP is rising, it signals expanding economic output. Businesses are thriving, consumers are spending, and confidence is high. For traders, robust GDP growth often translates into bullish stock markets and a stronger national currency. Inflation, on the other hand, measures how quickly prices for goods and services are rising. Moderate inflation is usually a sign of a healthy, growing economy, but when it gets too high, it can erode purchasing power and prompt central banks to hike interest rates. Rising interest rates can, in turn, strengthen a country's currency, as higher yields attract foreign investors, but they can also put pressure on stock prices, as companies face higher borrowing costs. Interest rates themselves are a direct lever for central banks to influence the economy. When rates rise, borrowing becomes more expensive, which can slow down spending and investment. When rates fall, the opposite occurs, stimulating economic activity. For traders, watching central bank announcements is critical, as even a small change in rates can ripple through every corner of the market. Unemployment rates round out our top economic indicators. Low unemployment typically signals a strong economy and can stoke wage growth, which boosts consumer spending, a positive for equities. High unemployment, conversely, is a warning sign of economic weakness, often preceding stock market downturns. So, how do these indicators affect us as traders? They form the foundation of trend forecasting. A string of strong GDP reports can boost confidence in a country's markets. A surprise rise in inflation can send shockwaves through currencies and commodities. And when unemployment numbers deviate from expectations, swift market reactions are common. By staying attuned to these numbers, you can anticipate shifts, manage your exposure, and make proactive rather than reactive decisions. Next, let's turn our attention to company fundamentals, the bread and butter of stock traders. Evaluating a company's financial health is more than just glancing at its stock price. It involves a deep dive into its earnings reports, balance sheets, and cash flow statements. Earnings reports reveal if a company is profitable and how its performance compares to expectations. Strong earnings can spark buying interest, while disappointing results often trigger sell-offs, but earnings are just the start. The balance sheet provides a snapshot of what a company owns and owes, its assets and liabilities. A strong balance sheet with more assets than debts suggests financial stability and resilience. Cash flow analysis is equally vital. Even profitable companies can run into trouble if they don't manage their cash effectively. A healthy cash flow means a company can fund operations, invest in growth, and weather tough times without resorting to expensive borrowing or diluting shareholder value. To make sense of these numbers, traders use financial ratios. The price-to-earnings, or PEE ratio, helps gauge whether a stock is overvalued or undervalued relative to its earnings. The debt-to-equity ratio measures financial risk, telling you how much of the company's growth is fueled by borrowing. These ratios allow for apples-to-apples comparisons between companies, helping you identify strong investments and avoid potential pitfalls. But no company exists in isolation. Industry and sector analysis is the next layer of fundamental analysis, providing vital context for your trades. The performance of an entire sector, be it technology, energy, healthcare, or finance, can make or break the prospects of individual firms. Is the industry growing or contracting? Are new regulations on the horizon? Is competition fierce, or is your company a dominant player? For example, a surge in healthcare stocks might follow an FDA approval or breakthrough drug, while energy stocks could rally or tumble based on shifts in oil prices or new environmental policies. Tracking these broader trends lets you position your trades for maximum impact, diversify your portfolio, and predict which stocks are likely to outperform. However, even the strongest company or sector can be shaken by global events and geopolitics. Elections, wars, trade disputes, and natural disasters can send shockwaves through financial markets in an instant. The price of oil can soar during Middle East tensions, while trade wars can slam exporters and reshape supply chains. The COVID-19 pandemic, for instance, crashed markets worldwide, only to be followed by historic stimulus-fueled rallies. Staying informed about these events allows you to adjust your strategies, hedge your positions, or even capitalize on sudden price swings before the broader market catches on. Volume and market sentiment are also critical, yet often overlooked, aspects of fundamental analysis. Volume tells you how many shares or contracts are being traded, and high volume usually confirms a strong trend. A breakout on low volume might be a false start, but when everyone is buying or selling in unison, the move is more likely to stick. Market sentiment is all about the prevailing mood among traders and investors. Headlines, social media buzz, and news flow can sway sentiment in an instant, driving short-term price action. Monitoring sentiment indicators and online conversations can give you an edge, helping you anticipate moves before they show up on the charts. Finally, never underestimate the power of market psychology. The markets are made up of people, and people are often driven by emotion: fear, greed, hope, and panic. Herd mentality can fuel bubbles and crashes, while overconfidence can lead to costly mistakes. Tools like the VIX, which measures market volatility, and bull-to-bear ratios, can help you gauge when the crowd is too euphoric or too fearful, highlighting opportunities to act against the herd. In summary, mastering fundamental analysis isn't just about crunching numbers. It's about understanding the bigger story behind every price move. The interplay between the economy, individual companies, industry trends, world events, and human psychology all shape the markets we trade. By looking deeper and asking why instead of just what, you can sharpen your edge and trade with greater conviction. Remember, it's not just about how prices move, it's about why. Stay curious, keep learning, and trade smart.